Well, I recently spoke to Graham Tucker from Old Mutual Balance Fund. He's the manager there, for some perspective on the current global economy and how it might impact on your investment decisions. Let's take a look.
We need to distinguish between the stock market and the economy. So if we look at the stock market, what we've seen there is that market has more than doubled in the last year as money's flown in, as investors have almost speculated on that market. And then you've seen the correction over the last few weeks and I think that's really what's caused a lot of the panic out there. But you have to remember that the market is still significantly up over the last year. If you turn to the economy, though, what we've been saying for a long time is that China is going through a transition as it changes from an investment-led growth model to a consumer-led growth model. And what almost inevitably has to happen is that their growth rate has to come down. So you saw double-digit growth through the 2000s, and we're expecting growth to be significantly lower going forward. So this is a structural slowdown in the economy in our view. And importantly, this isn't an all fall down. It's not a hard landing that we're calling. We're saying it's going to get slower over a period of many years. And really the Chinese authorities have the ability to stem a hard landing. So that you see them cutting deposit rates and lending rates. You're seeing them put all sorts of other action into place to try and stop the economy from falling apart completely, from growth collapsing. So in our view, growth is going to slow in China, but it's going to be a structural, gradual decline in the growth rate. And so what that really means in terms of investments is, if you turn to commodities as an example, you saw a massive demand for commodities coming out of China through the 2000s. And as that demand was coming through, you saw a supply response. But now, as the demand is weakening on the back of the lower growth going forward, the supply is still coming online. So now you've got somewhat reduced demand versus increased supply. And what that means is that it's going to put a ceiling on commodity prices. And in our view, that's why we're seeing commodity prices falling. If you look at commodities such as iron ore. So that's a fantastic example of how that supply has just come online rapidly. There's not enough demand out there, and so the prices fall. Hence, in our portfolios, what we've done is we've rotated away. Quite some time ago, we rotated away from those counters that had exposure to the Chinese commodity plays, and prefer to put our clients' money to work in other areas of the markets.
If we turn our attention to Greece, that's also been a significant sore spot over the last few days, and I understand that we might not have felt the pinch just yet, because we know that the Greeks obviously need to vote on the particular amendments and reforms that are part of the terms and conditions of the bailout. But does this maybe just dampen the mood and the level of optimism when it comes to investing in the Eurozone overall?
Right, so I think you need to look at Greece in a global context. So it's less than 1% of global GDP. It's 0.03% of the MSCI All Country World Index. So Greece in isolation isn't incredibly significant to markets. I think what people are concerned about is that a collapse in Greece or an exit from the Eurozone leads to contagion, and you see the other peripherals such as Spain, Portugal, and Italy. They're at risk of also then exiting. And in our view, we don't think an exit is likely. Obviously, there's still a risk to it, but we think that if you look at where Greece sits today relative to 3 years ago, and where the Eurozone sits, it's in a much healthier position. So let's take a look at a few examples. The ECB is engaged in quantitative easing. There's a rescue fund that they've put in place. And if you just look at the European bank exposure to Greek sovereign debt, that has come down significantly over the last few years. So if you look 3 years ago, the debt on banks' balance sheets was sitting at roughly $200 billion. That's now decreased to about $35 billion as that debt has been written down and taken onto the ECB's balance sheet. So in terms of the risk of contagion through the rest of Europe, we don't see that as a major risk in our portfolios. And in fact, that's one of the biggest positions that we have in our portfolio. We prefer European equities over, for example, United States equities, because we see that there's more value there, and we see that that Europe is gradually recovering. It's not to say that it's off to the races, and obviously there'll be concerns around Greece and the impact of Greece, but we do see that European growth is actually recovering. And you just have to look at Spain and Portugal as examples of that. So they've taken the austerity hits over the last few years, and they're starting to come right. They're showing signs that it is possible to grow. So rather than thinking of this as austerity measures, rather think of it as a way of enhancing your growth going forward, of a growth reform package.